$5,000. That's the number most people believe they need before investing even starts to make sense. It feels like the minimum entry ticket to the market. Anything less than that seems too small to matter. But what if that assumption is completely wrong? What if a portfolio built with just $5,000 today could grow into something far larger over time, not by chasing the next hot stock, but by using a few carefully chosen funds designed to compound steadily year after year? In this video, we're going to build exactly that. We're going to take $5,000 and construct a simple portfolio using 3 ETFs that cover nearly every major part of the market. Each fund plays a different role. One focuses on broad market growth. One emphasizes consistent dividend income. And the third adds an additional layer of diversification that helps smooth out volatility along the way. By the end of this video, you'll see exactly how this portfolio works, how each piece fits together, and what kind of growth it could realistically produce over time. Because when people talk about investing, they often make it sound complicated. Charts, indicators, predictions about where the market is heading next week or next month. But long-term investing doesn't need to be complicated. In fact, the strategies that tend to work best are usually the simplest ones. The idea behind this portfolio is straightforward. Instead of trying to guess which individual stocks will win, we build a system that allows us to own large pieces of the market itself. That way, when businesses grow, innovate, and generate profits, our investment grows alongside them. And that approach becomes far more powerful when time enters the equation. Compounding is the force that turns small investments into meaningful portfolios. The money you invest earns returns. Those returns are added back into the account. Then the next round of returns is calculated on the larger balance. Over time, the growth begins to accelerate. At first, the progress can feel slow. The early years of investing rarely look dramatic. But as the balance grows, the compounding effect becomes stronger and stronger, eventually doing more work than the original contributions themselves. That's why starting early matters far more than starting with a large amount. A portfolio built with $5,000 today and given decades to grow can end up far more powerful than a much larger investment started later. So instead of trying to build wealth quickly, the goal of this strategy is to build something that works quietly in the background, steadily expanding while you focus on the rest of your life. Now, before we look at the specific funds in this portfolio, it's important to understand one key concept that connects all of them together: ETFs. An ETF, or exchange-traded fund, is essentially a basket of investments. Instead of buying shares of a single company, an ETF allows you to buy a small portion of hundreds or even thousands of companies all at once. If one company struggles, the others help balance it out. If entire industries grow, the ETF captures that growth across the portfolio.
This is one of the reasons ETFs have become such a powerful tool for long-term investors. They provide diversification, simplicity, and exposure to the broader market without requiring constant research or trading.
And the 3 ETFs we're going to use today each bring a different advantage to the portfolio. One focuses on overall market growth. Another emphasizes strong dividend income. And the third helps tie the entire strategy together by adding balance between the two. Individually, each one is powerful. But when they work together inside a single portfolio, they create a system designed for steady long-term growth. So let's start building the portfolio. The first ETF we're going to add is one that many investors consider the backbone of a long-term strategy.
The first ETF in this portfolio is one that many long-term investors consider the foundation of a simple, reliable strategy. If you had to choose a single fund that captures the performance of the broader U.S.
economy, this would often be the one people point to. That fund is VOO, the Vanguard S&P 500 ETF. VOO tracks the S&P 500, an index made up of 500 of the largest publicly traded companies in the United States. These are businesses that dominate their industries and generate massive amounts of revenue every year. Inside this single ETF, you'll find companies like Apple, Microsoft, NVIDIA, Amazon, Alphabet, and Berkshire Hathaway. These organizations operate across technology, healthcare, finance, consumer goods, manufacturing, and nearly every major sector of the economy. Instead of trying to predict which of these companies will perform best, VOO simply holds all of them in proportion to their size. When the largest companies grow, the ETF grows along with them. This approach has produced remarkably consistent long-term results. Over the past several decades, the S&P 500 has delivered average annual returns around 10% to 11%, including reinvested dividends. Some years are stronger, some years are weaker, but over long stretches, the trend has historically moved upward. That's why so many investors use the S&P 500 as the core of their portfolios. It offers broad exposure, strong long-term growth, and a structure that requires very little maintenance once the investment is made. Now let's see how it fits into the $5,000 portfolio we're building. In this strategy, we allocate 40% of the portfolio to VOO, which means $2,000 of the initial $5,000 investment goes into this ETF. That portion of the portfolio is designed primarily for growth. The dividend yield of VOO sits around 1.3%, which means it does pay income, but that income isn't the main attraction. The real value comes from the steady appreciation of the companies inside the index. Over time, those companies grow their profits, expand their operations, and increase their share prices. As that happens, the value of the ETF rises as well. And when those dividends are reinvested back into the portfolio, they begin to compound alongside the price growth. To understand what that means over time, imagine that the S&P 500 continues delivering roughly 10% annual returns. At that rate, the $2,000 invested in VOO would grow to roughly $5,200 after 10 years. By 20 years, that same portion of the portfolio could reach around $13,400. And after 30 years, the original $2,000 investment could expand to roughly $35,000. That growth happens without picking individual stocks, without constantly trading, and without trying to predict which companies will dominate the market next year. Instead, the strategy simply allows the largest and most successful companies in the economy to drive the portfolio forward. But while VOO provides strong long-term growth, it isn't designed to produce large amounts of income. That's where the second ETF in this portfolio begins to play a different role, because the next fund focuses specifically on companies that not only grow, but also return a meaningful portion of their profits directly to investors through dividends. And when those dividends begin compounding over decades, they can become one of the most powerful engines inside the entire portfolio. While the first ETF in this portfolio focuses primarily on long-term market growth, the second fund takes a different approach.
Instead of simply tracking the largest companies, this ETF looks specifically for businesses that consistently return profits to their shareholders.
That brings us to the next piece of the portfolio, SCHD, the Schwab U.S. Dividend Equity ETF. If VOO represents the broad engine of market growth, SCHD represents something slightly different: quality companies with strong and reliable dividend income. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which selects companies based on several key characteristics. The companies inside this index must have a long history of paying dividends, strong financial health, stable earnings, and a track record of increasing those dividend payments over time. In other words, these are not companies chasing rapid expansion at all costs. They are businesses that have already established dominant positions in their industries and are consistently generating enough profit to reward their investors year after year. Inside SCHD, you'll find companies such as Coca-Cola, PepsiCo, Home Depot, Cisco, Texas Instruments, and many others. These are firms that sell products people continue to buy regardless of whether the economy is booming or slowing down. Because of that stability, SCHD often plays an important role in balancing portfolios that might otherwise rely heavily on growth stocks. Now let's look at how SCHD fits into the $5,000 portfolio we're building. In this strategy, 35% of the portfolio goes into SCHD, which means about $1,750 of the initial investment is allocated to this ETF. Unlike VOO, where most of the return comes from rising share prices, SCHD delivers a larger portion of its return through dividend income. The dividend yield typically sits around 3.5% to 3.7%, which is significantly higher than the broader market. On top of that, the companies inside SCHD have historically increased their dividends at a steady pace over time. This combination creates an interesting dynamic inside the portfolio. While VOO focuses on growth, SCHD begins generating a growing stream of cash flow. And if those dividends are reinvested, they start purchasing additional shares, which then generate even more dividends in the future. That cycle continues year after year. So what does this look like over time? If SCHD continues delivering returns in the neighborhood of 10% annually, similar to its historical long-term performance, the $1,750 investment could grow to roughly $4,500 after 10 years. By 20 years, that number could approach $11,600. And after 30 years, the SCHD portion of the portfolio could reach nearly $30,000 while also producing a steady stream of dividend income along the way. But the most important role SCHD plays isn't just growth or income by itself. It's the balance it creates within the portfolio. When markets become volatile, dividend-focused companies often behave differently from high-growth stocks. Their earnings tend to be more stable, and their dividends provide an additional layer of return even when stock prices move sideways for a while. That stability helps smooth out the overall performance of the portfolio. Now we have two major pieces in place. VOO provides exposure to the largest companies driving economic growth. SCHD adds high-quality dividend companies that steadily return profits to investors. But the portfolio still has one missing ingredient. Because the final ETF adds something that neither of the first two funds fully provides additional diversification across the entire market, including smaller companies that can grow much faster over long periods of time. And when that final piece is added, the portfolio becomes far more balanced than any single fund could achieve on its own. With the first two ETFs in place, the portfolio already has strong foundations. One fund captures the growth of the largest companies in the market, while the second adds reliable dividend income from financially stable businesses. But there's still one important piece missing. So far, the portfolio has focused mostly on large, well-established corporations. These companies are powerful and stable, but they're not the only part of the economy where growth happens. Some of the fastest growing companies in history started as much smaller businesses. Over time, many of them expanded rapidly and eventually became the large corporations that dominate the market today. To capture that broader range of opportunities, the final ETF in this portfolio is VTI, the Vanguard Total Stock Market ETF. Unlike VOO, which focuses only on the largest 500 companies, VTI tracks the entire U.S. stock market. That means it includes large cap companies, mid-sized businesses, and thousands of smaller firms across every major sector. Altogether, VTI holds more than 3,500 companies. When you invest in this fund, you're not just owning the biggest corporations you hear about in the news. You're also investing in smaller companies that are still growing, innovating, and expanding their influence in the economy. That additional exposure adds an important layer of diversification. Sometimes large companies lead the market higher. Other times, smaller companies experience faster growth. By including the entire market, VTI helps ensure the portfolio participates in whichever part of the economy is performing best at a given time. Now let's see how this final ETF fits into the $5,000 portfolio. The remaining 25% of the portfolio is allocated to VTI, which means about $1,250 goes into this fund. VTI typically produces returns very similar to the overall U.S. stock market, averaging around 10% per year over long periods of time. It also pays a small dividend, usually around 1.4%, which adds an additional component to the compounding process when reinvested. So what does that mean for the long-term growth of this portion of the portfolio? If the market continues delivering around 10% annual returns, the $1,250 investment in VTI could grow to roughly $3,200 after 10 years. After 20 years, that portion of the portfolio might reach approximately $8,400. And by 30 years, the investment could grow to roughly $21,000. Individually, each of these numbers may not seem dramatic, but when VTI works alongside the other two ETFs, the entire portfolio becomes much more powerful. VOO drives long-term growth through the largest companies. SCHD generates rising dividend income and adds stability. VTI spreads the investment across the entire market, capturing opportunities wherever they appear. Together, these three funds create a diversified system that doesn't rely on predicting the future or identifying the next winning stock. Instead, the portfolio simply allows the broader economy and the companies within it to do what they've historically done over long periods of time: grow. Now that all three ETFs are in place, it's time to step back and look at the bigger picture. Because when you combine these investments into a single portfolio, the numbers become far more interesting than any one fund on its own. Now that the portfolio is complete, it's time to step back and see what these three ETFs can actually do when they work together over the long run. Remember, the starting point was simple: $5,000 invested today. The portfolio splits that money across three different roles. About 40% goes into VOO, capturing the growth of the largest companies in the U.S. economy. Around 35% goes into SCHD, focusing on stable dividend-paying businesses that return profits directly to investors. And the remaining 25% goes into VTI, spreading exposure across the entire market, including smaller companies that often grow faster over time. Individually, each of these funds is powerful, but the real strength appears when they begin compounding together. Let's imagine the portfolio grows at an average rate of about 10% per year, which is roughly in line with the long-term historical performance of the U.S. stock market. In the first decade, the growth still feels modest. After 10 years, the $5,000 portfolio would grow to roughly $13,000. At this stage, the contributions and the returns are still working together, and the compounding effect is only beginning to gain momentum. By year 20, the portfolio could reach around $34,000. Now, the investment gains are doing far more work than the original $5,000 contribution. The compounding process is starting to accelerate, but the real transformation happens in the final decade. By year 30, the portfolio could grow to approximately $87,000. That means the majority of the portfolio's value didn't come from the original $5,000 investment. It came from the decades of compounding returns layered on top of each other. And this is where many investors underestimate what time can do. The early years of investing rarely look exciting. The growth feels slow, and it can sometimes seem like the numbers are barely moving. But as the balance becomes larger, each percentage gain represents more and more money. At some point, the compounding begins to work faster than the original contributions ever could. And the portfolio we just built doesn't rely on risky strategies or concentrating to achieve that. It relies on something much simpler: owning large pieces of the economy through diversified ETFs, allowing companies to grow, reinvesting dividends, and giving the investment enough time to compound. This is the quiet power behind long-term investing. You don't need perfect timing. You don't need to pick the next big stock before everyone else discovers it. And you don't need a massive starting balance. Sometimes the most effective strategy is simply building a system that works steadily in the background. Because over time, even a relatively small investment like $5,000 can grow into something much more meaningful. And if you want to see how some investors turn dividend portfolios into $4,000 per month in passive income, there's another strategy worth exploring next.